Candlesticks are one of the most important concepts to learn when it comes to trading, and knowing how to correctly read candlesticks helps you understand the market, make more informed trading decisions, and easily avoid losses you would have taken otherwise. But most traders don't know how to use candlesticks properly. In this video, we're going to break down exactly how to read candlesticks. Not just what they look like, but why they form, what they mean, and how you can use them to build high-quality trades. So if you've ever been frustrated trying to figure out when to enter, when to wait, or why a setup looked good but failed, this video is going to clear that up. Before we can talk about the different candle types, we first need to understand what a single candlestick is telling us. A candlestick is just a simple way to show what happened to price during a certain period of time. It tells you where price started, where it ended, and the highest and lowest points it reached. Let's start with the open. This is where the price was at the very start of that time period. So if you are on the daily chart, this is where price first opened that day. And this is the close, the price at the very end of that period. In this example, the close is higher than the open, which is why the candle is green. The very top of the candle, here, is the highest price reached during the time period. And the very bottom, here, is the lowest price reached. This large rectangular part in the middle is called the body. It shows the range between the open and the close. The thin lines above and below the body are called wicks. The top wick shows how far price went up before falling back. The bottom wick shows how far price went down before rising back up. In this example, the candle close is lower than the open, meaning that the candle is red. So green means price closed higher than it opened, and red means price closed lower. A green candle shows buyers were in control, and a red candle shows the opposite, and that sellers were in control. So that's the anatomy of a candlestick. Everyone you see on a chart shows this same basic 4 bits of information: the opening price, closing price, and highest and lowest price during the period. Once you understand this, it makes it much easier to read the story the candles are telling you. So, moving on. Now that we understand the anatomy of a candlestick, let's look at the 3 types of candlesticks you'll see on any chart. Every candle will look slightly different in some way from the previous candle, but there are only really 3 types of candlesticks on a chart. These are strength candles, control flip candles, and hesitation candles. Before we start, it's important to note that each candle is a visual representation of the psychology of the market. It is showing a battle between buyers and sellers during that period. Keep this in mind throughout this video, as it will give you a deeper understanding of each candle and the psychology behind it. Let's start with strength candles. A strength candle may be bullish or bearish, depending on which side, buyers or sellers, is in control of the price. A bullish strength candle shows clear control from buyers. Price opens here at the bottom of the body and closes here, near the very top. The large green body shows strong upward momentum. Price rose significantly over the period. The small wick at the bottom tells us sellers tried to push the price down, but buyers quickly pushed back and regained control. The fact there's only a small wick at the top means buyers stayed in control and the candle closed near its highest point. A bearish strength candle is the opposite and shows clear control from sellers. Price opens here at the top of the body and closes here near the very bottom. The large red body shows strong downward momentum. Price fell heavily over the period. The small wick at the top tells us buyers tried to push the price higher, but sellers regained control quickly. The fact there's only a small wick at the bottom means sellers stayed in control throughout the period. Now, there are different variations of strength candles. A strength candle with no wick at all is the strongest type of strength candle. On the left, a bullish candle with no wicks means buyers were in control from the start to the end. Price only moved in one direction, with 0 pushback from sellers. No wick means the sellers never forced the price the opposite way from where it started. That makes these candles even stronger than those with small wicks, because there was no sign of hesitation or rejection during the entire period. A no-wick strength candle signals strong momentum. These candles are a strong hint that the next move will follow the same direction. But remember, the strength of the signal always depends on the overall chart context, not just the candle itself, and we will get into how to use these candles in context correctly later on in this video. Now, the size of a strength candle also matters. The size of a strength candle tells you how powerful the move was during that period. On the left, this large bullish candle shows strong momentum. Price moved a significant distance from open to close. On the right, this smaller candle still meets the definition of a strength candle. It has a solid body and small wicks. But the move was less dramatic. A large strength candle means there was a surge of buying or selling activity, with more urgency and volume behind it. A smaller strength candle shows there was still control from one side, but with less conviction. So in summary, a strength candle shows the market has moved strongly in one direction. Its body is noticeably larger than surrounding candles, and there are either no wicks or the wicks are relatively small, showing the opposite side barely influenced price during that period. These candles form when buying or selling activity is dominant and sustained with little interruption. That can happen when traders react strongly to new information, or when one side finally breaks through after a period of balance. A strength candle is a sign that the current direction has force behind it. It gives a strong hint that the move is likely to continue in the same direction. Recognizing a strength candle quickly helps you see who's in control and anticipate what the price might do next. Next, we have control flip candles. A control flip candle shows a clear handover of control between buyers and sellers during the same period. So if we are looking at the daily chart, it shows control shifting over the course of a day. On the left, you can see a bullish control flip candle. Price opened here, then sellers drove the price down at first, leaving a long lower wick, but buyers fought back and closed the candle near the high. On the right is the opposite, a bearish control flip candle. Price opened here and buyers pushed price up early, leaving a long upper wick, but sellers stepped in, reversed the move, and closed the candle near the low. The wick is the most important feature for a control flip candle. It shows who tried to move price in their favour but failed to hold on. The close then shows us who actually finished the period in control. These candles often appear when the market tests a certain price level and gets rejected, or when sentiment changes quickly within the session. An important point about control flip candles is that it doesn't really matter what colour the body is. The most important signal is in the wick, with a long lower wick meaning sellers lost control and a long upper wick meaning buyers lost control. So in summary, a control flip candle is a signal that power in the market has shifted. These candles stand out because of their long wick on one side. The wick shows that one side of the market pushed strongly but couldn't keep control. A bullish control flip candle forms when sellers drive price down, but buyers step in and finish near the high. A bearish control flip candle forms when buyers push price up, but sellers push it back down, closing near the low. They often appear near turning points in the market, when momentum has been running in one direction, but begins to fade. These candles are most useful as potential reversal signals. A bullish control flip candle after a decline can point to the start of price moving upwards. A bearish control flip candle after a rally can signal that sellers are beginning to take over. The general idea is to buy when you see a bullish control flip candle and sell when you see a bearish control flip candle, but overall chart context matters, which we will get into shortly. Now we move on to the third and final type of candle, a hesitation candle. A hesitation candle shows uncertainty in the market. It's easy to spot. The body is small, meaning the opening and closing prices ended up almost at the same level, and the wicks are even on both sides. This tells us neither buyers nor sellers managed to gain control. The hesitation candle is different from the other two types we've covered. A strength candle shows one side in full control, and a control flip candle shows a clear change of control. A hesitation candle is neither. Instead of control, it shows balance. Both sides tried to gain control, but neither succeeded. These candles often form at decision points, after a strong move, at key levels, or during quieter periods where traders are waiting for new information. A hesitation candle is more of a warning than a signal. On its own, it doesn't tell you where price will go next, but it does tell you the market is at a crossroads, and what comes after often reveals who will take control. That's why watching the candles that follow a hesitation candle is more important than the hesitation candle itself. Hesitation candles don't all look exactly the same. They come in a few variations, but they all tell the same underlying story of balance between buyers and sellers. The most common is the small body hesitation candle, but they can also have no body, a small wick, and a large wick. But what they all show is an equal attempt by buyers and sellers to drive the price higher and lower, and the close eventually ends near the open. When it comes to trading with hesitation candles, they are different from the other types we've studied. You can't really trade them directly because by themselves, they don't give us a clear direction. What they do instead is act as a warning. They tell us the market has paused and that buyers and sellers are evenly matched. Let's look at this example. On the chart, we can see a resistance line at the top, where price has bounced off of a couple of times. You can then see 3 hesitation candles form just underneath it. Each candle has a very small body, with even wicks above and below, showing the market is struggling to break higher. Buyers are testing the resistance but failing to push through, while sellers are holding their ground. Then immediately after these hesitation candles, we see a large, bearish strength candle. This candle confirms that sellers have stepped in with momentum, rejecting the resistance level and forcing price lower. This combination can be a strong setup. The hesitation candles show the battle at resistance, and the bearish strength candle confirms which side has won. Together, they can create a clear selling opportunity, because the rejection at resistance has been proven by strong downward momentum. The key takeaway is that hesitation candles aren't entry signals by themselves. Their value comes from the context they form in, and what happens next. When you see hesitation candles forming at an important level like resistance, and then a strength candle breaks in the opposite direction, it often marks the start of a decisive move. Now it's time to use what we've learned in the context of a real chart. Let's first go through and identify the 3 different candles we have looked at on the chart. If you look here on the left-hand side, notice these large-bodied bullish candles. These are strength candles, and they're the ones driving the market higher. You can see how just a handful of these candles creates the entire upward rally. Moving further along, notice here, a series of large, bearish strength candles. This is the exact opposite. Sellers taking full control and forcing the market lower. What's important is that it's these strength candles that actually create the swings on the chart. Without them, the market isn't progressing. Now if you look here, you'll see a candle with a long lower wick, with the body closing near the top. That's an example of a bullish control flip candle. Sellers attempted to push the market down, but buyers reversed it. It appears after a run of selling pressure where price has been declining, showing the sell-side momentum is breaking down. In this section, notice the candles are smaller, with wicks on both sides. These are hesitation candles showing indecision. Neither buyers nor sellers have full control. Here, hesitation forms for several sessions in a row, showing the market is stalling. Once a strength candle follows, it confirms the sellers have won the battle. Sometimes that means a continuation, other times it signals a reversal. Now let's connect these 3 candle types to the bigger picture. To successfully trade with candlesticks, it's important to understand you don't just use candles that form in isolation. You want to use them when they form around key levels in the market. For example, this rally of bearish strength candles reaches a low and then stalls. Buyers reject further progress, and that point becomes a key support level, especially if this has happened at this level previously. And as you can see as we zoom out, price has stalled at this level before. Every time price comes back to that level later, we already know it's a place where supply stepped in before. On the other side, notice this rally. It halts where sellers step back in, creating a resistance. Sellers were strong enough to stop price rising further, and it's these repeated reactions, the way candles interact with these levels, that create opportunities for us to trade. It's also important to compare momentum in the market and how quickly buyers and sellers move price. Looking again at this rally from support into resistance, it happens quickly with a small amount of large, bullish strength candles. Now look at the decline back down. It takes much longer, and the candles are smaller and weaker. This difference tells us the rally was impulsive and driven by strong demand, while the decline was corrective and lacked conviction. In trading terms, the impulsive side usually reveals the true direction of control. This is important as we always want to trade in line with who is in control of the market at the time. Analysing the speed at which buyers and sellers move price is a key indicator to who is in control of the market. Understanding this can help us build more profitable trading opportunities and avoid unnecessary losses. Now let's take everything we've learned so far and put it together into a complete trade idea. At this stage of the chart, we've identified two critical levels. First, the resistance at the top, formed when bullish strength candles lost momentum and sellers defended the high. As we noted earlier, that's where supply previously overcame demand. Second, the support at the bottom, created when the bearish decline was defended by a bullish control flip candle. That's where demand proved strong enough to stop the fall on multiple occasions. So how do we trade this? Looking closely, the decline into support has been slow and corrective, made up of smaller candles and some hesitation phases. Then, right at support, we see a decisive bullish control flip candle. Sellers tried to push through the level, but buyers absorbed the move and closed the session near the high. That single candle gives us a strong hint that demand has just reasserted itself, especially as this is at a level where buyers have stepped in before. This is an opportunity. Instead of waiting for a breakout later, I would place a trade here, entering long directly off the bullish control flip candle at support. So to structure this trade, this is how I would do it. Entry on the close of the bullish control flip candle at support. Stop loss just below the low of that same candle, under the support level. If sellers manage to drive price below that, it invalidates the signal. Take profit at the resistance level above, where sellers have already proven they're willing to defend. That's the next logical place for price to travel. This setup gives us a clean narrative. We're buying at support immediately after buyers showed their hand with a control flip candle, and aiming for the level above where supply last stepped in. Now everything about this trade is rooted in the candles themselves. The support exists because buyers defended it before. The control flip candle confirms they're defending it again, and the slower, weaker decline into that level compared to the fast rallies tells us buyers remain the dominant side. So the trade idea is complete. Buy at the control flip candle and set the stop below support and the take profit at the resistance level. Now let's move the chart forward and see how this trade played out. Straight after our entry, notice how price respects support. None of the following candles move below our stop level, which is the first sign that buyers are still defending it. Soon after, bullish strength candles appear and begin lifting price away from support. The move is impulsive, with large bodies and closes near the highs, exactly what we wanted to see. This shows demand stepping back in and taking full control. As the rally builds, notice the efficiency. Just a handful of bullish strength candles cover the same distance it took many more sessions for sellers to push lower. That imbalance confirms that buyers remain the dominant side. Eventually, price reaches the resistance level we marked earlier, but this time, instead of stalling cleanly beneath it, notice how the rally actually breaks through the level slightly. That tells us buyers are strong enough not just to test resistance, but to start pushing beyond it. In a situation like this, one option is to lock in some profit at the resistance level and then let part of the position run. By doing this, you secure gains in case the market reverses, but also give yourself the chance to benefit if the breakout continues. And in this case, the fact that price has pierced resistance suggests that demand may be building again. Even though sellers defended this level before, the candles are showing us that buyers are pushing harder this time around. Now, if you found this video helpful and you really want to take your candlestick trading to the next level, I've put together an ebook that goes much deeper into these patterns and how to actually use them in real market conditions. If you're serious about understanding candlesticks and becoming a consistent trader, this is something you don't want to miss. The link is in the description below. Make sure you grab your copy. But before we move on, in order to keep producing these videos for free, we need your support by hitting the like button, subscribing and turning notifications on.